stop losses are probably one of the most important things that we're dealing with, and everybody has a little different angle on it. And it starts with psychology is the first thing. And what I want to do is I'm gonna find my screen here to share. And what I was gonna do is I just wanted to show. That should bring it up. You guys got the screen. So I know me and Scott have talked about this before numerous times, but this book, Trading in the Zone, is probably one of the most valuable tools in your toolbox. It teaches you about trading psychologically without worrying about the trade. It doesn't matter if the trade goes bad or good or whatever. You just take and trade what's in front of you, and you don't let it affect you mentally. You don't go in biased. You just trade as things go, right? So a lot of people will get into FOMO, fear of missing out, and really that's something that you need to break that habit, because every day is a new day. Every day we get new trades. There's always another trade. If you missed a trade, that's something that you just look for the next setup. That's what we do every morning. If we miss one trade, we'll say, okay, it went too far, and we'll just jump on and look for the next trade, and away you go. I mean, there's hundreds of trades every day. So pick the right one for your strategy, and that's what you want to work with. We talk about trades, but back and forth to Scott and me and Jeff, and some of the other members, they'll say about this, say First Solar's running or Tesla's doing this, and even though we're talking about them, we're talking about setups, you don't want to get to the point where you feel you have to jump into every trade we're talking about. You want to pick and choose your trades. The ones that Scott calls out are probably a higher possibility to run, or a better chance of it, because they're a little more set up in them. But a lot of the stuff we're seeing it real time. Okay, this one's looking like it's setting up, and at the same time we'll also say, well, if it goes over, say, a 132 level, it's going to validate this trade. So wait till it gets over, and not just that it gets to the point and pops through. You got to actually have it go over a little retest, and after it takes off, then we feel that that's most cases that's a great trade. The other thing is getting into stop losses when it breaks back down below the entry we called. In most cases, that's a good time to get out. And I don't mean as soon as it touches it, but if you have a candle break below it, that's where you want to be. That you're going to jump out and you're going to look at it from a point of view. Okay, that trade is no longer good, and it might even save you from getting in past it or losing a 20% stop loss on it, which we're going to cover more on as we go. So one other thing I wanted to show you is let me see if I can bring it up this way, or I might have to actually share my screen a little bit differently. There's a lot of options for you when you're looking at buying puts and calls, and say for example, Apple, AMD, and SPY are unique in the way that their pricing is. Their bid and ask are usually very, very, very close. So if you got, say for example, this is off a TD Canada Trust website, and yours will be differently, but you can see you have a bid right here, you have an ask, and very importantly, you have the price, and you have open interest, and you have volume. Open interest is the volume over the contract term, how much volume is there. The volume is the actual daily volume. So that's something to keep in mind. You can see, how much has been in the past, and the building, and then how much, that day is. Now, when you get in and out of a contract, you have the option of buying the bid, buying the ask, buying mark, which, we highly, recommend you don't do, because you don't know where you're going to get up or where you're going to get in. If it happens to fluctuate, you can get a very unfavorable trade. So playing things like Apple and SPY, it's easier to get in with a bid or even an ask, because they're very, very close. I prefer trying a bid, or the best rule of thumb is you look at price over here, and you can see what was the last price. And you can see then, okay, well, this is bid, so you can enter as a bid, and if you need to move it up a little bit. But things like as Apple, AMD, SPY they're great to deal with for that way. You also want to look at, okay, do we have a lot of volume on that? Can I get in and out easy? So, and when I show you the next one, it's going to give you it'll show you that, just bear with me. I gotta show you some that are a little tougher to trade with. And one is like LMT. Now look over here, here's your volume. Here's your open interest. So it's virtually nothing. So you can go into a trade like this and you get a bad fill and you're down 20% before it even moves. So keep in mind when you're entering a trade, you look at the bid, the ask, previous price, and then look at the volume. Like some of these are only 3 people, 10 people. The high is 312. I mean, this still is not a very desirable one to be in because it can fluctuate back and forth. You got a big spread between bid and ask. So unless you're thinking there's going to be a big move, I tend to try to avoid ones like this. And many times Scott will mention that this isn't a favorable bid ask situation, or the spread, we call it the spread, is too far. So that's something that we're always looking at too as we're doing it, right? Now that gives you 2 good examples. There's a lot more extreme ones as you get into a few of the stocks that are way out there. So now just bear with me. I'll bring up so there's numerous ways to look at your stop losses and worry about when to get in, when to get out.
How long until you want to eat?
For a little while.
You want to
Soon or is that no?
mute that?
Yeah, we can. Yeah, I want my eating soon.
Jeff. So I got a couple examples here for you. Now, one of the nice ways to look at it is you can run off the EMAs. Lots of times you can run off a 9 EMA for a 5-minute chart or a 20 EMA for a 1-minute chart. Even using the 9 EMA for 1 minute isn't even that bad. But to give you an idea, here's a run up in Apple. And I had to pick and choose a couple different ones that probably look good for us. And this is kind of a bit of an example where we got. I'm going to show you probably a couple strategies here. But you can see on a 1-minute chart, the 9 EMA is the green line. Okay. Now, if you were to follow a break of a candle, you probably would be out here on a 9 EMA if you're following 9 EMA on a 5-minute chart. But if you were running a 20 EMA, using the 20 EMA, which is the blue one, it would have kept you in on this whole run because we didn't break until you actually get to the top. And where they almost, probably somewhere over here, they cross, and you would give you a good opportunity to get out. So this isn't foolproof. This isn't, there's different ways you can look at it. There's you can tweak them. You can go in and change your settings. So maybe you want to run a 15 EMA instead of a 9 EMA. Now we can go that. I can explain that later too. But it's as simple as going into your indicators, changing the EMA to something that falls a little bit closer. Like I customize them for a 3-minute chart. I'll do something a little bit different. Like for a 5-minute chart, I'll have a 250 or for a 1-minute chart, and then I'll have a 50 for a 5-minute chart. So when the 5-minute 50 and the 1-minute 250, they're basically the same. So there's different ways to do it, but I think it's a great idea to look at it like this, where you have a chart on this time frame. And I'm going to jump over just to show you the same chart actually over here, and then we'll jump back.
Okay. You want to check your screen share? I'm not sure if you're sharing the screen that you want. At least I'm still seeing the.
I'm sorry. Did it? How far back did I not? There
you go. Yeah.
Okay. Has it changed?
The chart, unfortunately. I'm sorry.
Oh, to the 5-minute, or the previous one didn't show?
No, it did not. It was still on.
Okay.
The options.
Oh, okay. I'm sorry about that. Sorry, everyone. So let me redo this one because it's important that you see what's happening here. And so as a general rule, like the 9 EMA for a 5-minute chart, as long as and a 20 EMA for a 1-minute chart, if you're a little more conservative, you can see the green. Once we started running up, if a guy would have waited for the break, come back in a retest, and we would start running up. You see, as long as we don't break below the 9 minute, okay, and here we would have broke below, so you probably would have wanted to get out. But you got to remember, this is also a 1 minute chart, so you can run the 20 EMA, which is the blue one I usually keep, or if you wanted to set it to 18, or some people run a 12. It's just another different strategy you can watch. But if you're running a 20 EMA on the 1 minute chart, it would have kept you in all the way until you actually drop below right here, which is a little different way to look at it. Whereas we're going to get into the 20% strategy, but this is a nice way to keep you in a trend or to keep you out of a trend, so you see what's happening. And it also works in a lot of different places. You just stay there with the depending on which EMA you're using in time frame. I customize them a little bit as I go on, but as a general rule, if you're watching the 9 EMA and the 20 EMA on a 1 minute chart, it gives you a pretty good idea what's happening. Now I'm going to run over to hopefully it'll stay okay. So here's the same thing. Now when we go over to a 9 EM on the 5 minute chart, here we are. You can see that the 9 EMA follows it nicely also, which is the green one that I'm showing you. And that follows it nicely along. If you would try to run the 20 EMA, which is the blue one on the 5 minute, it wouldn't take you out properly until probably well over here, and by then you'd probably hit your losses. It wouldn't be favorable. So at the maximum, I think a 9 or a 12 for the 5 minute chart would be great. But the 1 minute, which I usually run in, you can play with the 9 or the 20. Also, what I do is I use a different strategy, and what it is, it's a little bit of Fibonacci, and I'll use a 23 to 38% retracement. And it doesn't work in every situation, but when something is running hard with some pullbacks, it keeps me in the trade, and it gives me indication if I lose that lower one. And what it is, essentially, it's just taking setting up your fibs for this. So you'll take the first wave. You see we're at 23% is the first pullback, and 38% is the second. Now you see it keeps you in the trade. We haven't broke below it. Now I can take this to the next wave right here. See, there you go again. We still haven't broke a candle below it. And then once we start to get into a little bit of a chop, then that gets to be a little bit of a thing. You could hardly use it here, but when it's running hard, it gives you a bit of an idea of once you break it, it's time to get out. I mean, essentially, it's tried to break there and it hasn't. So when you have a fast trending stock, that works actually really nice. In fact, I'm just going to show you over here just to give you an idea. I'll remove this one. Whatever it is, I keep that on. But if I was to do the same thing here on the bottom for this one right here, I'd have went up. It broke the 23%, broke the 38%, and I would have got out here. So I'd have made, I would have probably had to move from here back to where it broke, a smaller move. But then when it made the second one, I could have put it back in, even though I wouldn't have probably jumped into it until it was. Let me just move over here. Jumped into it until it was probably coming back up, because I'd want to seen it actually break the highs. But you can see as it pulls back and it breaks the 23, breaks the 38, and you're out. And this is all stuff you can test as you go. You can also do it. On the downside. You can do it on a couple different ways. We've been playing the upside for quite a while, so now we're playing the downside. You got to just flip everything over the other way. What's your thoughts, Scott? I mean, I know I've kind of been taking up a bit of the time here, and I want to get your thoughts on what's your thoughts on the 9 and the 20 and that time frame, and even this pullback Fibonacci stuff.
I think that everything you shared is, it's you hit it spot on, first of all. But second, I love seeing the levels and when you can show somebody it's like light bulbs go off when you show them the lines. But
Yeah.
a lot of times you can also drown yourself in trying to understand each and every one of those. So start with what I suggest is start with one of them and master each one. When he talks about the 9, the 20, and the 50, do some only play with one at a time, and then you can add the layers as you go, because then you will have learned what to watch for instead of overloading your brain with trying to watch these 3 or 4 or 5, 6 different levels. He is showing you how it works against different time frames, and it's so freaking important what he is showing you. But I don't want you to get lost in it at the same time. So while he's teaching you all this, take one at a time. Take 3 different tickers and only show one of these lines on each of the tickers. Is it being my best advice, so that you can see how each ticker reacts differently to each line before you're trying to memorize all 3 or watch all 3 at the same time. Because what he's showing you can change so much of your trading results. The levels never disappoint. Like when he shows you that retracement of that pullback, it didn't dip below. A lot of people would have paper handed that. And that's what he's trying to teach you right there is don't paper hand, but you have to understand how these tools can be a resource to you to ensure that you don't make those mistakes, because he would have stayed in that trade example. He would have stayed in and then even doubled probably, or at least increased the trade profitability tenfold, fivefold, threefold, onefold, whatever it is, because he's using the proper tool that told him that he doesn't need to exit. But if you don't know how to read these, which of course we're teaching you how to read those now, if it seems overwhelming, I guess is where I'm going with it. Start with one, add the second one, and then do the third one, and then back test those against decisions you've made in previous trades. And you can literally see where, and then all of a sudden the light bulb will click, because you're basically comparing what versus what you were just taught, and then it'll all click. But great levels, great information for sure.
Well, the other thing too is every second week we run a Q&A session. So I'd be happy to take, if you guys wanted, we could set up some Fibonacci indicators. We could set up, some EMAs and, with the VWAP, and there's numerous things we can do. So if it's something that interests you and you want to go into it detailed, we can sure do it. You might find if you only want to use one indicator, maybe we set up maybe a 12 EMA, and then you just watch that one. Because there's a lot of stuff to look at, and that's what we're here for. We're here to make you successful traders and teach you everything that we know and learn along the way. So now we have a couple of things. Like I'm bouncing around a little bit too, because I've kind of showed you these charts and I've showed you this. So lots of times through the day, Scott will mention, I'm going to front run it, and it was hard for me to find a good example of that today, but because the market changed and started trending down. But I'm going to use this as an example, and you can tell me, Scott, if this is what you think of this one. So normally, if you'd have been looking at this, and once we broke here and started broken these support lines, if you'd had some good candles, you could have started looking at this. Okay, it's going down. We broke our levels, especially once we broke right here. Would you not agree, Scott?
100%. I love the front running, and I love that you're explaining the difference, because that's how because everybody's trading strategy, everybody's portfolio, everybody's if you want to use the slang term, your bag, how much of your bag you're risking. You have to. If we give you the right information, you can make a lot of people in trading, they think that everything is everything has to be the same. What works for me and what works for somebody else may be different, because we're dealing with 2 different types of risk tolerances for different size portfolios. I might be managing 5 trades, you might be managing 2. There's so many different variables that go into it that front running, I only front run generally when I'm having a really good day or I have profits to where I can add on a layer of risk. But if you're not in a situation where you can add on a layer of risk, then you need to wait for confirmation. Front running is a way of adding a little additional profits, or you're getting a better price premium in anticipation of what you think is going to happen. But the word think is the key word instead of confirmation. What Clint's showing you right here is the difference between what you're thinking and what's confirmed. And when what he's fixing to illustrate, and I'm going to shut up after this, the front run is the higher risk trade, the safer entry, clear words, clearly defined, safer. It's a confirmed entry. So when I'm taking a front run, that doesn't mean that when I speak that, I'm the reason why we use a lot of generals is because you have to take and apply what we're saying from a trading perspective and fit that into what your type of risk and your scenario is at the time. For example, me, Clinton, and Jeff all trade differently. Me and Clint seem to be always in line on our charts and our entries and exits and our confirmations, but I'm still a little bit more aggressive than him. So we might be on the technical side aligned. We maybe have a different risk tolerance. And so that's when you have to understand what some of this information that is being provided isn't necessarily, it's for, first of all, you can't give financial advice. Second, we can't tell you specifically what to do. But third, it is giving you information to make educated decisions without having to second guess yourself by utilizing and leaning on someone that has all the tools or has the resources, the history or the education or the experience or all of those combined to arrive at an executed position or entry on the entry or the exit.
Yeah. So with that being said, like Scott's obviously he takes a bit more. He's a little, I wouldn't say riskier, but he well, maybe it's riskier, but he's definitely got a lot more years experience than me, and he gets right after, right, where I'm a lot more cautious. So Scott would be in the trade, now if we'd have broke back above approximately where this front running line was, he probably would have get out somewhere around there, or maybe even up a little higher. But to the safe side is we know it's trending down. Scott's in. Now, because he said front run, it doesn't necessarily mean you have to jump in, because there's usually a good line that Scott would consider a safe entry. And so would I. So once it comes down, it touched that line, went back up, and once she breaks down below, you see all this other support line, now you broke that support. Now, once you broke that support line, now we have a confirmed trade. Now we're rolled. So, and we have a gap down over here. So we have a good chance of success that this trade is going to go, and it's going to go probably fairly hard. So especially if you confirmation, you have SPX or ES are also trending in the same direction. That's a kind of a nice added benefit. But trade like this, once he's here, this is I wouldn't say guaranteed, but it's a pretty safe bet that you're rolling, especially when you're looking at this kind of a numbers or that kind of a charts and stuff. So. And I was also just going to show you a couple examples, like, Netflix and all these, as they were running up, they kind of did the same thing too. Like you can look and see it never did break that 23 and 38%. You move it up to the next level essentially, and it didn't break it again. 23% is a really nice rebound area. If it stays on that 23%, on hits there, you have a nice chance of it bouncing up. If it, see here, you'd have to move it up a little higher then for the next one. But once it breaks down, but by then, if you were even looking at your 9 or even your 20, it would have took you out. That would have been your safer place to get out. The other thing is, see, here's another one I was going to show you. We might have front run around here, but once we break in these levels to the upside, we're feeling pretty confident that the trade's going to start to go. And you can also look at when you break it down, your 9s and your 20s. There was another one that I wanted to roughly show you too, is and SPX is always a good example, is SPX, is good to see for trending, but a lot of times, you want to watch a trend line too. And once you actually break a trend line, and we quit making lower lows and lower highs and lower lows and lower highs, and the trend started reverse, we're starting to make higher highs, higher lows, higher highs, higher lows. You look at it from the point of view, the trend's changing. If I'm not out already, I should be out, right? Or I need to know what's kind of going on. You can also see here's your green line. This is on the 15-minute, but it would look pretty close to the same. It might curve a little bit more on the 1 or the 5, and no chart is the same. But that's something you also you got to keep an eye on too, is when it changes direction, you're no longer making, if it's going down, you're not making lower lows and lower highs and lower lows and lower highs anymore, and it starts changing, and you start seeing, there's a higher high, there's a higher low. You got to look at how much of a pullback, and ideally, if you're a newer trader, that you definitely want to be out there before it kind of eats you up. There was a couple more things I just wanted to point out to you, because I'm working on a different time frames. I want
Hey,
to.
Clint,
Yeah.
can you go back to that real quick? Because you have a perfect setup for something.
Okay, yeah, no problem, man, no problem. Let me
Sorry.
find it again.
I'm sorry.
Yeah, no
Okay,
problem. No, it's good. It's good. Yeah.
Right. Okay, so right there, straight up. Right there. You see that rejection right there?
Yeah.
Can you cover how you would know that it's changing directions? Explain your line right there. Obviously we're above the trend line, but we're at the blue line. I don't know what color codes you use, so I'm not sure what line that is, but I'm guessing that's is that the 9 EMA?
Well, actually, you'd laugh because I run 1,000 EMA also. And I'll explain that to you sometime, but because it seems to always work on the 3-minute, and sometimes the 5-minute, and 1,000 EMA on a 1 minute is a 200 EMA on a 5-minute, which is actually quite important. And that's why I leave it there, is because it helps me pick up all these EMAs that are floating around, so I don't have to jump back to 5, and I just don't have to, so just to give you an idea. Yeah.
But how could you drum that down for
the
less
candlesticks?
advanced trader? Well, just on how would you drum it down to how they would notice or know that there's a rejection taking place right there?
Yeah.
Go ahead.
The cool part about it is that's what I was going to do. That's the cool part. But you got me on it, and that's absolutely wonderful. First, I was going to take it down to like the 5 minutes, so I had a few more candles to look at. And I was going to actually show the 2 different types of candlesticks, because I use Heikin-Achi because they show you a trend, and they show you a trend the way the trend keeps going. And when a Heikin-Achi goes from green to red, we definitely have starting to see a trend change. Now, there's also the fractals. So you look at the 5 fractals, which are the 5 upper ones, and if they're like a V, it's a good chance they're changing. But now let me show you. See, this is Heikin-Achi, so it's different. It's showing you, okay, once a Heikin-Achi doesn't show you a peak to the top, it's basically starting to change a trend, so. And you can see here. So once a Heikin-Achi like here actually shows both ways, that's almost a doji. Now let me show you what Scott was referring to. I'm pretty sure was the candlesticks. And what we're going to do is we're going to look at the candles on it to see how. Okay, we were going up in green. We hit here, and we started to get a rejection, and then we had a bullish engulfing actually hammer down, and this more than likely is an order block in here, which we would have to watch for in the future. Would that not be on track there, Scott, what you were referring to?
I think you nailed it without me even having to say it. But yes, that's exactly. You want to show what I was trying to elaborate on is that you're showing is how to identify. It's overcoming emotion by looking at the candles and understanding this candle is saying X, versus, oh, I think it's going to do this. Well, you think that in your head, but the exact candle and the exact levels show you it's not.
Yeah. Now I know I know there's a reason I run these Heikin Achis, because they show me trends, because I read things a little differently, but there's nothing wrong with whichever candle you like, right? This isn't as much of a doji, but lots of times you'll see it peak up. Let me see if it changes on the 1 minute. You'll see it peak up, and it will give you a little bit more of a indication of an actual doji on a bigger time frame. And I don't know if this one will. I'll try, but yeah, there you go. There you go. So, okay, there you go. There's a doji. Okay, buyers were pushing it up, and bang, they got hammered right back down. See, so on a smaller time frame, you can see they tried to make it go, and they got kicked down. Now, it's a lot better doing it on a higher time frame, because 1 minute is so confusing. You know, when you start to go, even if we went up to like 30 minutes, and then I'd have to probably find a little bit different one. Like a lot of guys will try or trade on a 5 minute or 15 or and see, here's even a doji on the bottom side, right? She hit, and then she hammered her back up. Now the way the candlesticks work is with these is it's going to be green if it opened lower. If it opened lower, and let's grab a little bit more detail maybe. Okay, so it opened lower, and that's why it's green, and it closed higher. But it was pushed all the way up to here, and the buyers hammered it right back down, so it probably closed right about here. You jumped into here, and they're already starting to push it down, and now that's why it's red, because now it basically closed below where it entered, and then went here and hammered back up. But obviously, I'm on a higher time frame. So candlesticks in itself is very unique as far as reading them. There's patterns, there's H patterns, there's many different things to look at. But usually dojis and engulfing candles, that's your main ones that you want to be looking at, and then like a fractals where you got like five together that are pointing to reversal, or just stuff like that. There's Japanese candlestick books. There's many different ways to do it, but that's what I really want to show you was take a look at how this looks a little rough. In fact, let me just make it clear it up a little bit so you don't have to look at all this stuff here. Now, because this is SPX, let me do maybe ES. One that we have is running around the clock. So yeah, that looks a little rougher. See, here's a doji right here. A doji right here. She got kicked back down. She got kicked down. They kicked it back up. Same thing there, back up. But what I'm trying to show you is the candlesticks will usually many times give you a bit of an indication. Now, this looks like a lot of confusion. You can go in and you can look at it closely. The reason I like the Heikin Achi is because it just smoothes everything out for me. I got longer reds, I got longer this. As long as I'm seeing, the tail on it, that's giving me direction. This means that it pulled back a little bit. Direction up, pulled back, because they're on both sides of tails. And then I just find it a little easier for me to the type of trading I do to find the leads, which is mainly what we're looking for, and the levels. It's easy, but you just whatever works better for you. That's what it is. If you want to read candles, you need to use these candles, which is your standard candles. What's your thoughts on that, Scott?
On the candles, definitely the Heikin Ashleys are the candles, because they're the easiest to understand, even though they're not really the standard. I don't like the hollow candles. I like the full. I've always liked the Heikin Ashleys.
You can do lots of different ones, right?
Yeah, for sure. And there's no wrong way. That's where people get confused. There's no wrong candles to use, or they wouldn't have different ones. They would only have the one that works. But different ones provide different types of insight, and they cater to different types of trading. These candles, for all intents and purposes, are easier to read if you understand them. But these candles, if you learn the candle patterns, which are hard to do, it's over time. But these candle patterns don't mess. They don't mislead. Especially if you look at like 1030 on his current chart that he's looking at right there. A lot of people would have saw that first red candle. But you see how it's the wick is on the top and the bottom, and the candle is actually in the middle of it, right at 1030, the first red candle.
Oh, this one, yeah. Right there, it's
Yep.
3 minutes, so it'll be right around here, yeah.
Yeah, right there. But you had dip buying and you had rejection. Then on the next red candle, the second red candle, you had dip buying, which pushed it back up with a smaller rejection. That tells you that the smaller rejection means that there's more buyers than sellers on that second red candle 4 or 5 to the right of him.
Oh, over.
Right
Over
to
here?
the left, to the left, to the left, to the left. One, two, those two candles right there.
Yeah.
So the first candle, the first red candle, that's a confusion candle. There's sellers and buyers at that moment in time. The next candle, there's more buyers dipping on that candle with less of a rejection. Then you had the small green candle, which then, if you look right at the very bottom, you can see the ascending volume straight down, all the way down. You
Yeah.
can see the ascending volume that aligns with those candles going up. They were buy-side green volume with candles. I would have stayed in that trade with those two red candles because of the candles that I see. A lot of people see two red candles. Oh, I got to lock in. In that scenario, with the first one with the two wicks and then the other one with the opposite wick, I would have never left that trade. But that's stuff that evolves over time, and that's I think it's part of, like, sometimes when we trade, you can look at something, open up a tab, whether it be YouTube or Google, and when you see something or you hear something, go watch a video real quick in real time. The video is not going to be live, but it'll be real time of a current situation that you're watching, and then you'll be able to visualize it and you'll reference it the next time you see it happen.
If you guys do decide to run Heikin-Achi candle, make sure you click on real price on price scale, because if you don't, Heikin-Achi gives you two different prices and you're always looking around. It drives you absolutely nuts. You want to have the actual price, and that's why you click on here, go into settings, go into candles, right click, open it up and click real price on price scale. And that will give you the real price, even though the candles are a little, they have a little longer stems on them and everything, but that's just it took me a while to get that one sorted out and figured out too. So that's something that's rather important too. Now, does anybody have any questions? I know we covered quite a bit of stuff, and I'm hoping that we'll have lots more question sessions coming up in the future.
We got a couple minutes left, Clint. I'm looking in. Nobody's put anything out on the chat for questions, but if anybody has anything, feel free to throw it out there.
What I could do is actually, I'll go back to this chart. Is if you did just go ahead, yeah.
So, for example, today on SPX. So I just thought, I said, for everybody's got to be afraid of the Fed minutes, things like that. So I put in a bunch of SPX puts, got super lucky, but I didn't know where to come out. So I had a 0.5 trailing stop, and it kicked me out. But had I known, it went negative like 54 points. And that, yeah. So how would I what would you do in that situation?
Can I chime in, Clint? And then
you go ahead, and then I also need you to, before I forget, I need you to go on your 20% stop loss theory also, okay?
Okay, I'll close my side with that as
Yeah.
a follow up at this question.
Yeah.
I'm going to give you the cheating way. There are indicators that you can learn, not so you never have to learn because it's better to learn, but there are indicators that can give you levels. And Clint's great at the indicators, like with TradingView and what indicators to use. But there are indicators that will give you the level. You can. There's a. You can. They don't have it as a. I'm sure there's another one. I'll tell you one. I don't really normally share this because I like to have some of my tools that. But I will give you this tool. I generally use a thing called Bookmap, which will show me. It's not a. They don't have an indicator that allows you to use it for TradingView. It's not a. It doesn't work with TradingView, but Bookmap shows me where the sellers are and the buyers are. But you do have to flip to a different screen. I'm sure Clint will have a better solution to it, but I like to look at where the sellers and buyers are, because then I know if it has further downside or upside based on the order book, but the real book, not your BS level 2 crap that everybody wants you to use. But there's also some indicators that will show you real-time support and resistances, and they can show you intermediate, first level, second level, third level. A lady that I know really well uses it's called Phantom Spot. She has a great her script is and I don't get it any let's find it. I don't have it in front of me, but it's Phantom Spot. I can find it for you and send it to you if you text me. I don't get paid. I'm not an affiliate for her, but I love. She built one herself. That's a great levels thing, and then where to look as where the next thing to simplify it, and then I'm gonna kind of wrap it up with this. If you want the easiest solution, is look at the previous day highs and lows. You also look at the pre-market and after hours highs and lows, and use those as established baselines. If you break below, so when you see that support level, like that previous low, that's where you're going to be watching it to see if it's going to bounce or break below that support. If it breaks below that support and you're on a put, then it's going to accelerate the gains. If it holds that support line, then that's when you know it's time to get out and let's take the profits or the gains that we have sitting right there in front of us. That's the key. But there's multiple ways of learning how to use that. First, you can use different assistance tools while you're learning to guide you. And then you can also use simple things by recording the previous day's lows and highs and the pre-market and extended hours lows and highs. Those are probably the two best things, plus whatever Clint's going to wrap up with after I talk about the stop losses. I promise you he's got some type of indicator that will accomplish that same goal. And then the 20% stop loss is very simple. Swings, I like to extend it to 30. But 20% stop loss rule, I don't care if you use 25, 35, I don't care if you use 50. The rule is not the percentage of stop loss. The rule is using the same stop loss across the board for all trades, so that when we're giving out trades that are setups, and Clint mentioned in the very beginning, there are trades that are real-time triggered, and there's trades that are news-driven, and there's other things. But trade setups, ones that are pre-planned, pre-marked, they're technically earmarked. We're waiting for an alert. We're waiting for something to activate the trade or trigger the trades. Those trades are designed. they are complete setups. So when those alarms go off, we have what we take a risk versus reward ratio. I use normally a 3. Basically, I have a higher risk versus, or higher reward versus risk in said trade. And those in different scenarios will change those levels of the risk versus reward, which will void or validate a trade. And so the key is by doing that, the only way it works is to keep, the second you go from a 20% to a 40% stop loss, now we have to take 2 additional trades to balance out that risk versus reward ratio on those trades. Because what happens is you let this one go to 40%, let this one go to 20%. If you were to manage the risk, we don't have to profit, so we don't have to make a trade go from, we could take 4 20% trades, profit trades, and net out great gains instead of having to go for that home run or that big winner to offset all these big losses. Because again, now you're at a 4-to-1 risk versus reward ratio is a scenario. So 20% stop loss is what I like to use because I like to use tight stops. And that allows me to manage the capital in a more of a defined what's the word I'm looking for? Can't use my words today. In a defined environment that it doesn't change day by day, where the probabilities and the outcomes are managed and they're the same expectations every time, so that if something doesn't work out, my risk versus reward is maximized by using these probabilities and the downside, the upside risk versus reward. And if you do that, you'll notice that you'll start to have higher profitable trades because you're not watching these trades go red because you didn't understand the candles or any of the scenarios that, the emotions that take into account. But moving forward, Clint can obviously, I know he's already found an indicator, and I actually was not looking at this screen the last 5 minutes, but I already know that he has one to solve or to give you that will assist with that same.
Well, you
scenario.
can buy a lot of them, right? That's the thing. There's indicators you can buy, but one that's free, which it's called Smart Money Concepts, Lux Algo. I think it's like 30,000 people or got it for free or whatever. When you actually go into it, I got it on one of my favorites there, but it's we'll just show you. Smart Money Concept, like 29,656 people use it. So that says something in itself, right? That and it's kind of cool. What it does is it gives you this, it tells you this is a strong high, this is a weak low, this is, it gives you a bunch of other little indicator or stuff that you can look at, and it also draws some lines for you. There's that one, and you can play with. And I always recommend this Trendlines V2 because it pops up trend lines at just the greatest time. So Trendlines V2 2020, that's a great one to have. And then as far as trend lines or setting your levels, once you see them, they become quite obvious when you're setting up for the day. You're looking for your highs, you're looking for your next level back. You start on a higher time frame so you can see, if there's numerous places they balance, just makes them stronger. And then once something becomes a support, it usually turns into a resistance. And once it's, or a resistance to support. So that's just something that you practice with as you go. Usually in the morning when we get on 15 minutes before for the live trading, we'll, I'll do a minor level of that on this smaller time frame, looking at what I'm looking to break on the levels. But you can easily start looking at what's higher here. You can put one here. You can put one there. There's all chances, and especially if if it's a number like say 4,500, that's a psychological number. You know, you're always looking at, you're going to see something bounce and, you know, 45,250 or, you know, things like that. You always see crazy stuff happen at those ranges, you know, but that's pretty much, I think, all I got. If anybody has any questions, you know, we're always free for answering questions, whether, you know, Jeff, myself or Scott. And if you get on before, in the morning too, we're good to answer questions. And many times, you know, I've stayed on myself, and so has Jeff after live trading. If somebody has a question, we've even ran through and, you know, in detail on specific things. So anytime that, you know, whatever we can do to make you a better trader, that's what we're here for.
Great. Well, Scott, any closing comments?
Just want to thank y'all for your time. I really appreciate y'all doing this. Thank you.
You're welcome.
Hey, we're gonna keep trying to add value and teach you. You know, it's all about you know, having the confidence, and the only way you can gain confidence is by experience and having somebody to lean on to or resources. And a lot of times people just don't know where to look or know how to learn, or they know how to learn, but they don't have the information of what to go and learn. And so I think that the biggest value here is you can get information to go and start learning things, not only from us, but on your own with the information provided. And then you don't end up in rabbit holes that end up being a waste of your time, or you're not knowing, you know, did you go down the right rabbit hole? And quite frankly, that's the thing. People start into this trading world and they get really confused and they get lost because they start reading a book, or they start watching books or podcasts, or they start watching a lot of videos. And then the more and more, all of a sudden, they've watched 10 podcasts and they've watched 20 videos. And now they're just completely confused. And that's what we want to stop somebody from having happen, and to drum it down. You can overwhelm yourself with trying to learn all this. So drum it down, keep it simple. You don't need, people make this too complicated. They try to add too many indicators. They try to get too much information, and they overload themselves, and they get lost, and they start second guessing and then they look back and they're like, if I just would have done what I knew to do or what I thought to do, it would have worked out. So have a little confidence. And the best thing I think out of all this is probably the simpler of today's training is probably the simplest thing. Although that I don't want to insult Clint, but that book that he's talking about is probably the most valued. It can teach you more than me and Clint could spend 10 years every day of our lives trying to teach. That book will get you the right mindset to trade properly. And if you don't read that book, none of this matters.
It's even on Audible too. If you're not that type of person that reads, you can even listen to it on Audible if that's something that you prefer.
All right, everybody. We'll just kind of wrap up here. So appreciate you attending the session tonight. So we moved it to an evening session, and we're going to continue to make changes based on feedback that we got. So hopefully this was able to meet the needs of some different people. It will be recorded. It is being recorded. It'll be edited and sent to you next week. Probably edit it over the weekend, and we'll get it out to you next week. And for all the premium members, again, we've set up a new YouTube private channel for these training videos. So if you haven't gotten the link in the text that I've sent out, just reach out to me, and happy to do so. So again, thanks for attending, and look forward to seeing you tomorrow.
Okay, thanks a lot.
Thank you.
You don't always get to choose in this life, win and lose.